He is an auditor, and is on his way to meet his client. During this meeting, the auditor is investigating the client's standing, financial stability, and relation with previous auditor and apply procedure to communicate with predecessor auditor. The successor auditor should get the prospective client's permission to communicate with the existing predecessor auditor. If the permission is not given, the successor auditor should decline the appointment. If client grant permission to successor auditor, the successor auditor should inquire the predecessor auditor whether there is any professional reason for the proposed change. If there are such reasons, the successor auditor should request predecessor auditor to provide him with all necessary details in order to decide the acceptance of the appointment. If successor auditor does not receive a reply to his inquiry, he is required to send a reminder to the predecessor auditor or communicate with him through other means. If no response within a reasonable period after sending of 2 reminders, the successor auditor should inform the predecessor auditor of his intention to accept the engagement. Analytical procedure is a study of relationship between elements of financial information expected to conform to a predictable pattern based on the auditor's knowledge of the business relationship between financial and non-financial information. Types of analytical procedures. 1. Compare client data and industry data. 2. Compare client data with similar prior period data. 3. Compare client data with client-determined expected results. 4. Compare client data and auditor-determined expected results. 5. Compare client data with expected results, using non-financial data. One of analytical procedures most commonly used in planning is comparison of current balances in the financial report with balances of prior periods, and budgeted amounts.
Understand the client business and industry, including the audit risk. So you are the new auditor that I have from the director?
Yes, it's my pleasure.
My pleasure.
Yes.
So, sit down.
Since you guys know, I'm the auditor who has given permission by the board of directors to know more on the company's audit planning. May I know more?
Okay, so I was informed by the board director that you are going to enter the team. So what do you want to know about?
May I know more on the business and industries environment?
Okay. So Aris, can you help me explain this in detail to him?
Yes, thank you. Sure. So,
We need to understand the client's business and industry. Firstly, the information technology or IT connects client companies with suppliers and major customers. Secondly, the clients have expanded their operations globally. Thirdly, the information technology audit affects internal client process, improving quality and timeliness of accounting information. And lastly, increased the importance of human capital and other intangible assets has increased the accounting complexity and importance of management judgments and estimates.
okay, after hearing from the explanation, I think I have grasped some of the situation that your company is having. May I ask more? I want to know on how do you ensure an effective risk and evaluation?
Okay, so you want to know about this? Okay, I will want Amirul, can you help me please tell him in detail about our company situation?
Yes, sure. So,
First of all, we need to know the knowledge of client business. It is an important element to ensure effective risk assessment and evaluation. ISA 315 identify four broad areas of client, business, and its environment. First is industry condition, regulatory environment, and other external factors, including the applicable financial reporting framework. Next is nature of the entity, including business operation, investment, and financial reporting. Third, measurement and review of the entity financial performance. Last one is objective and strategies and real business risk, such as industry developments, new products and services, expansion of the business. So there are three audit risks: inherent risk, control risk, and detection risk. Inherent risk. It is risk that related to the characteristic of the business that may cause material financial statement. The factor used in assessing inherent risk is nature of client's business, integrity of management, client motivation, client knowledge of accounting standard, result of previous audit, susceptibility of defalcation, and nature of client's inventory and technological development. Control risk. This is the risk that the client's internal control will not prevent or detect material errors or misstatement in the account balance. Control risk exists due to the inherent limitation, internal control system, and inadequacy of the segregation of duties, such as human error and faulty judgment. Control risk high if internal control system is not effective, and control risk low if internal control system is effective. Last one is detection risk. So this is the risk that any remaining materials misstatement after assessing inherent risk and control risk will not be detected by auditor. It is a risk that the auditor's substantive procedure and review financial statement will not detect materials error misstatement. Detection risk high if the auditor are not competent and due care, and detection risk low if the auditor are competent and exercise due care.
Okay, thank you for your explanation, sir. So as for now, I think I have sufficient information on this company. If I want to know more about regarding the information of this company, I will inform you, sir.
Okay, so if you want to know more about this, I will conduct a meeting like this again.
Alright.
So for now, we can close the meeting. Okay?
Okay.
Okay.
Thank you for having us.
Materiality. Materiality is an entity-specific aspect of relevance, based on size or magnitude, or of the item to which financial information relates. Materiality concept. Information is material if its omission or misstatement could influence the economic decision of the financial statement users. It depends on the size of the item or error judged in the particular circumstances of its omission or misstatement. Consideration of qualitative factor in materiality. An auditor should consider qualitative factor as well as quantitative factor assessment. Qualitative factor include the significance of the item to the particular entity. The second one is the frequency of the misstatement. And the last one is the effect of the misstatement of the financial report as a whole. Quantitative factor to be considered. Change in the sales revenue, change in total asset, change in net profit. This factor can help both auditor and accountant to quantify the amount of misstatement, whether they are materially misstated or not.